Hello, family. This is Melissa Miller with the Melissa Miller Group at eXp Realty, and I'm coming with another video to answer questions that you want answered and with some great information. And I have my friend Ken Zorovich here, awesome mortgage professional, and I would like to introduce him and thank you, Ken, for stopping by to kind of clarify some information that's going out there about mortgages and the industry. So I'm going to ask you to just introduce yourself, let us know what you do, and a little bit about your company.
Sure, absolutely. Well, first of all, has there been anything going on the last couple of weeks that I missed? I'm not too sure if there's been anything happening out there.
Just a little, just a few things has been happening.
Oh, just a couple things have happened in our industry. So Ken Zorovich, Priority Lending, been in the mortgage industry since 2001. Was able to see what happened in 2008, and now we're kind of on the cutting edge of maybe something else happening. This is not all my fault, even though I've been in here this long, I promise. But just to explain to you what we do is we're a direct lender. We're also a seller servicer, so we have a lot of knowledge of the mortgage industry from all areas. And that's really what I think people need to understand is kind of the mechanisms behind our industry so they understand what's happening right now.
Exactly. So now the big question of the day, because so many people have been calling us. They saw the news. They said the interest rate dropped to 0%. What does that really mean? Can they get a 0% mortgage or refinance their rate down to 0%? What did that really do for us?
Sure, absolutely. So the first question I would ask people is this. If somebody borrowed or lent you money at 0%, what is the incentive for that person lending the money, right? There is none. There has to be an incentive or else we're going to all be out of business here. So the 0% interest rate is based off of what's called the federal funds rate. Okay, so the federal funds rate is the rate at which the Fed lends money to banks. Okay, and so that is a key rate, but it's really only important for banks. And the whole purpose of doing that was the Fed wanted to make money available to the banks in order to lend to businesses at a low percentage rate for things like lines of credit, business loans. And why were they doing that is because they know that businesses are going to be struggling for payroll and operational cost and things like that to try and buy some time. I think that's really what is the common theme of all the actions that we're taking right now is we had a very good economy, a very strong real estate market, and all of that is in jeopardy over an anomaly, which is a virus and a health scare here. So they're doing all they can to try and just buy some time, to give us time to get past the virus issue and be able to get back to functioning. But they don't want businesses to have to lay their whole workforce off, or else they can't just turn it back on. Like, it's not going to be that easy. If you have to go lay off all your employees and then you can do business again, you have to go back and then hire people in order to do that. So that's what the whole goal was. When the Fed drops rates, and those are the most popular rates you see on TV, they're never in direct contact with mortgage rates. Mortgage rates are really moving according to the bond market, which is just a separate animal. But the federal funds rate drives a lot of short-term loans like equity lines, credit cards, car loans. You know, if you have a car loan right now, it'd be a good idea if you want to try and refinance it because those rates are
adjustable rates, right? Adjustable rate mortgages would be
yes.
Would buy that too.
Yeah, exactly.
But how many of those are out there anymore?
Not many. Not many. Yeah.
Okay. So, so really, right now, where do you see the rate going? I mean, do you think it's high or is it
right.
still
So
competitive?
here's what we've seen with mortgage rates, and it's been in all my time in the mortgage industry, and we went through 2008, we've never seen mortgage rates do this. So I'll give you an example of what happened, why it was a problem, what the Fed did to try and help and created a bigger problem, and where we find ourselves today. So at the beginning of March, the economy started reacting to the potential coronavirus, right? And the stock market just started tanking. And normally when a stock market tanks, people start pulling their money from the stock market and putting it into the bond market, okay, for safety, right? Because that's a guaranteed low risk return, right? So what we saw was rates took a nosedive, okay, which you would think that's a good thing, right?
Right.
So our industry got flooded with people that wanted to refinance. Well, the problem was we have a capacity issue. There's only so many loans at a given time our industry can handle, okay? And if you want to look at it this way, there's about $15 trillion worth of mortgages out in the marketplace right now. When the rates dropped that first week of March, arguably $12 trillion worth of loans could be refinanced. Our industry can handle a capacity of about $1.5 to $2 trillion a year in mortgages. So that just goes to show you the supply demand was just way off. Like it was just too much, too fast.
Right.
So the industry pushed back and rates shot up just out of nowhere. They came up and spiked. So they were in the low threes. They got as high as almost 5% some weeks. And that is a huge swing. A big swing is normally about 1/8% in a week, and this was a huge swing. So we've seen this roller coaster ride, and really what we're trying to get to is some stabilization. And now the Fed tried to help out by buying mortgage-backed securities. Okay, that's in the bond market. If you buy mortgage-backed securities, it will push our rates down. Well, the problem is they went to do this, but investors out in the market did not see the value because they're concerned about potential delinquencies coming down the road. So why would you invest in mortgage-backed securities if you think they're going to have delinquencies?
Right.
So we really didn't have any positive effect to the Fed buying all these mortgage-backed securities. So
Okay.
I think what's going to happen moving forward now throughout this month is I do think over the next couple months, people will have some opportunities to refinance. There's a strategic way you want to do it. You want to be ready to pull the trigger on a rate lock. You want to be looking for that day to lock, which we usually see there might be 1 day a week, which is the best day to lock. But once there's some stability to what's happening in our industry, we will see more stability in the rate market. But we're still in that uncertainty phase. Like so many things are changing quickly with real estate and mortgages over the last 2 weeks that we just needed to almost stop so we can all react and come up with new processes for it.
Okay. All right. So what are you seeing for as far as somebody looking to purchase a home?
Yeah.
Are there stricter guidelines? Are you seeing some pulling back of some of the, I don't know, some of the latitude that they had? They were going up to what, 50% for your debt to income ratio?
Yeah.
So,
So here are the biggest changes we've seen in the last 2 weeks, and it really has to do with what would be considered a high risk loan. Because here's a good thing to understand about our industry is, you know, you were in 2008, I was in 2008. The biggest difference is 2008 was almost like a proverbial bomb went off.
mhm,
And then the government had about a 4-month period of time where they sat back, examined what happened, wanted to look at some ways they could fix it, and then came out with some plans. And that's what sparked short sales and REO properties and, you know, some of the mortgages that they put out to help out at the time. So they had that luxury. The difference right now is everybody kind of sees it coming. So it's almost like now instead of a bomb going off, we're trying to disarm a bomb before it goes off.
yes.
And that's the approach the Fed is taking with some of the support they're giving to our industry, because the reality is the market is scared we're going to have a high rate of delinquencies and then a high rate of foreclosures, and then our real estate market is going to start to suffer, right? That's what everybody's trying to protect against. So the first thing you can do on the originating side to protect against it is cut out what is considered a high risk loan. So a lot of the high risk loan programs have been put on suspense, okay? Now, this also includes loans that would allow for a lower credit score because those are considered higher risk than someone with a higher credit score. So if you just take out the group of the high risk loans, can you still get an FHA loan? Yes. Can you still get a VA loan? Yes. Can you still get a conventional loan? Yes. Can you still get a jumbo loan? Yes. They're just taking certain components out that are higher risk than others. We're not really seeing much change in debt to income ratio. We're not seeing much change in that. I would say the other area that has really been a focus from an underwriting perspective is when it comes to the the job sustainability of the borrower.
Mhm.
Normally, we verify employment within 10 days of closing. We're now doing it 10 days in closing, the day of closing, and we're trying to confirm, will this person continue to have a job after closing? If we think they're going to get laid off, we are not going to give a loan because we're worried they're going to fall into foreclosure or behind. So those are the two main components. High risk loans are being suspended, and really confirming that someone's job is sustainable going through this process.
Are you seeing a lot of people in the process of getting a mortgage and losing their employment? Are you seeing a lot of that happening?
We saw in the last 2 weeks, two clients that had been approved for mortgages and they lost their jobs.
Wow. Okay.
So
What are you
um,
doing in those
it's,
cases? Are you kind of putting it on hold and they're looking for another position? And if they do
yes.
find another position, can they just jump back into the process, or do they have to start all over?
Yes, they can, depending on the type of loan and what they're doing, they've got the opportunity to get another job and get that in place. And it's just unfortunate, but
Yeah.
it's just going to happen. It's a numbers game. It's going to happen to some people. But believe it or not, as much as I feel like there's a lot of fear out there of uncertainty. I talk to a lot of people who are just working fine from home and their businesses are functioning and operating.
Yes,
And I think this is going to change how people do business moving forward. You
definitely.
know, I
Definitely.
mean, I think this type of platform is going to become more popular. I think, people working from home might be more popular as we move forward because this is almost like a trial run where business owners are understanding what they can do, you
That's
know?
true. That's so true because, we've done many home buyer seminars in the past, and it's just opening up so many more doors. The technology that we have now to be able to educate the public in forums like this is just great. So that carries over into doing business. How are you seeing that the technology helping your business at this time? Are you doing more consultations by video or by
Mhm.
phone, or how is it working for you?
Yeah, we've always had the platform. We've had it for a while, but I love interacting with people in person. And so we'd always push for that for clients. But we're doing more of this. And I think what's going to help out the real estate market is, people immediate reaction these last 2 weeks. And I feel like been the problem is so many things were changing and there was so much uncertainty that there were people that like backed out of contracts and people that
Yeah.
backed out of certain things just because they didn't know what was going on. But once we settle down and they understand like, hey, this is kind of a new reality and this could be our reality for a few months now, I
Mhm.
think they will start embracing how real estate can still be done even in this type of environment
Yes.
where you've got virtual tours, you've got showings that can be done through video, you still have the ability to get home inspections where they're going to go to the property so you're protected as a buyer. Like there's so many things that buyers and sellers can still do, believe it or not, without physically walking into a property 5 or 10 times to see it. It can still get done, and if their job is still they're still working, they're getting their work done, they're still their business is thriving. There's no reason that they have to sit on the sideline. They just have to understand what are the nuances now that we just all have to be regulated under, right?
Right, exactly. Well, as we wrap this up, Ken, is there anything else that you would like to cover with us as far as information that you could share?
Yeah, absolutely. I think what's important also for people to understand is what are their options, okay, relative to what you see on TV of stimulus stuff. And, one of the biggest differences with the first stimulus package that went out in 2008 is everybody felt it was very, very catered to banks, right?
Mhm.
And listen, I didn't get a bailout. We would have liked to have one in 2008, but it was very catered to banks. This stimulus package is very catered to um, business owners and just like the working class of America. Okay, there's not really something specific for banks in here. Now they're doing some stuff behind the scenes to help some liquidity issues in our industry, but this is definitely something that's more about the people. But what I want everyone to be careful of is a couple things. One, there are options for forbearance where you can take some payments and throw them on the back end of the loan and not have to make your mortgage payment. This is not for people that are just looking for a break and want to save up some money. Okay. This is definitely reserved for people that absolutely need it, because look, it could affect your credit and your credit profile if you're taking forbearance. So you need to be careful of the details of what agreements you might agree to. So yes, check to see if you're eligible for it, because if you are and you need the relief, by all means, we would want you to do it, right? The second is there are a lot of small business loans available to people right now. If you're not aware of them, please reach out to Melissa. We'll get some information to you guys, but there are options for small business people to help keep their teams and their office together and pay some payroll and do all of that. And those are a great outlet. But bottom line is, what I want everyone to be careful of and just be cognizant as we move forward here. Remember, in any down market, one commodity that is going to be more valuable than all others is your credit, okay? Be very careful and do everything you can to protect your credit. In 2008, we had people that went to foreclosure, and for years they were in the home and fighting a foreclosure. The problem is, if you get into that position, it is so hard to ever come back. And what we saw in 2008 is all of a sudden, every other industry started using credit. Insurance companies wanted to run credit. Rental places wanted to run credit. You know, what was the other one? Utility places started running credit. Everybody started running credit. So remember, if we're going through any sort of period like that, credit will be king. So do whatever you can to protect it. If you think it's not sustainable to be into the property, start looking to list it before you get too far behind. That will give you more opportunities to bounce back quicker when the time comes for you to be back in a position to own a home. So don't be scared of that. Just understand your options, and obviously reach out to Melissa to talk further about it. So
Thank you, Ken. I appreciate that. So if you have any questions out there and you want more of an explanation, more information, please post it below, and I'll make sure that Ken gets those questions. But Ken, how can they reach out to you? What's your contact information?
yeah, so if you just want to try, our office line is a great way to call us, 954-438-3776. Great way to get us. We'd love to chat with you, answer any questions, and just help guide you through this, because I think that's what we all need, is just a little bit of guidance to understand what's going on out there. The more we understand, the less we're going to be fearful, right?
Absolutely, absolutely. And we also, the Melissa Miller Group also has a list of free resources for individuals and families, along with banks and credit cards that are offering assistance. So feel free to reach out to us at 954-388-7653 or email us at info@mmillergroup.com. We would be more than happy to email it to you. And thanks so much again, Ken, for sharing with us.
My pleasure.
It's always a pleasure. And we look forward to talking to you again soon.
Awesome. Thanks.
Have a good one.